Welcome back to the Retire in BC podcast. If you've been diligently contributing to your RSP for years, today we're going to unpack what happens when it's finally time to take the money out. Frankly, this is a must listen if you're 55 or older or you're planning ahead. I have found one of the most common questions I get from people who are approaching the point of wanting to take money out of their RSP is, how does it all work? And it's very little understood. So we're going to explain that to you and walk you through how it works. But first, we want to give you a quick recap of RSPs and how they work. Ben, you want to tackle that?
For sure, yeah. So in a past episode, we talked about some of the account types that are out there, the really common ones being the TFSA, the RSP, and the non-registered accounts. Just as a quick recap, I mean, the RSP, Registered Retirement Savings Plan, the idea there is that when you're depositing funds to that account, basically you're deferring that income or that money for your retirement. So you get this big tax break up front. And then later on, when you withdraw it, then you get taxed. And so that's really what we're going to talk about now is, when can you withdraw it? When do you have to start withdrawing from it? How does all of that work? And yeah, so basically on that note, at some point, well, actually, I should even backtrack. You are allowed to withdraw money from your RSP. We talked about that in that past episode as well, that if you want to, you can make a withdrawal from your RSP. You just are taxed and you don't get the contribution room back. Another thing that you can do, and at some point you have to do based on age, is you could transfer the whole RSP into another account type, which is the RRIF, or the Registered Retirement Income Fund. Right.
So I'm going to actually just use my old analogy, like I did when we did the RSP talk. If you think of an RSP like a tax haven island, you earn this money and you don't want to pay tax on it, so you move it over to that tax haven island, and now it's sitting there, and it's as though you never earned it, but it's sitting there, it's yours, it's growing, it's doing its thing. And as Ben said, when you want to take it back, it may still be an RSP. You can take it back whenever you want ad hoc. But when you come to the point where either you're turning 71 or you want it on a regular basis, now you want to convert it to the RRIF, because the RRIF is designed, or the Registered Retirement Income Fund, that's what a RRIF is designed to take the money out of, as opposed to putting it in. An RSP isn't designed to take the money out of, so you can only do it ad hoc. With a RRIF, you can do it on a regular basis. So it's sitting there on that tax haven island, and now you're going to repatriate it. You're going to take it out of that tax haven island or move it back to your mainland month by month, let's say. You've got lots of options. That's the most common one. And now you're going to get taxed on it just like it's regular income.
Yeah, well, and I think it's worth pointing out too, while we're still talking about the RSP mainly, and we haven't really gotten into the income side of things, is just that when you do make a withdrawal from the RSP, we've mentioned it's taxed. You're going to get, at the end of the day, when you do your tax for the year, you're going to have to pay that. But there's also upfront, this isn't necessarily a separate thing, but upfront, there is a withholding tax. So basically, if you pull out, let's say 10 grand from your RSP, the financial institution that you're using, they know that at the end of the day, that's going to be taxable income to you. And so they have to remit a certain portion of that money to the government on your behalf right up front before it even hits your bank account. And so that's not an additional tax, or at least not on the year. Like whatever your tax rate shakes out to be when you do your taxes, it'll all shake out. But basically just right up front, you're not getting all of that income. Some of it has to be put through to the tax man. And to some degree, that can be true with the RRIF as well. I just wanted to highlight that there is a slight difference how that works. And in an RSP, that is a factor that you're going to have the withholding tax there.
Yeah, I think it's worthwhile thinking of that like your payroll deduction. You know,
Yeah,
when you get
exactly.
your paycheck, they're holding back some tax, sending it to the government so that you don't owe them 20 grand at the end of the year. CRA wants to make sure they get their money. So the same thing's required with RSP withdrawals and with RRIF withdrawals that are over the minimum required. So that there's some fancy rules there. But basically at the end of the day, it works out to the same. It doesn't matter. Ultimately, when you do your taxes in April, you're going to pay the same tax, whether it's a withdrawal out of an RSP or out of a RRIF. They're just regular income. It's just that withholding tax that we're talking about. Like
Yeah.
the other thing that I'd like to just sort of point out, um, a lot of times I find people are really confused. They think they have to cash out all of their RSPs at the end of the year or do it's some big thing to convert it to a RIF. And I have often pulled out a statement that said RRSP and I've crossed off the SP and changed it to IF and said that's all that's going to happen. You're going to get a new piece of paper that instead of saying RSP, it's got RIF. The same investments are held there. There's just two rule changes. Number one, you're not allowed to put any money in. And number two, you have to take a little bit out every year.
Yeah, yeah, yeah. And so, as we already mentioned, I mean, you can move your RSP to a RIF whenever you want. In Canada, now I know in the States they've got some rules about early withdrawals prior to 55 or what have you. In Canada, we don't have that. You can move your RSP to a RIF whenever you want. You can pull money out of it. The restriction or when you have to do this by is all about the age 71. So oftentimes we're doing it a little bit before that. I'd say most frequently we probably do
Yeah,
it
usually.
upon retirement. So whether that's 65 or 68 or early, oftentimes. So most frequently we do it when you need the income, we turn it to an income fund. But if you don't need the income, if you've just got the funds sitting there growing in your RSP, at the end of or by the end of the year that you turn 71, you do have to turn your RSP into a RIF. That doesn't mean that quite yet that year you have to make the withdrawal. It's then the following year, so the end of the year that you're turning 72, that you have to actually be withdrawing some of that money out of the account.
And, I think it's worthwhile pointing out just because you have to withdraw it doesn't mean you have to spend it.
Mm-hmm.
The It's a minority of clients, but we have quite a few who just don't need that money, don't want that money. And so rather than taking a monthly payment, and we'll talk about some options there later, but instead of doing that, we just have an automatic once a year transfer into a regular investment account. And then if they need money, they can take it from there. But they satisfy that minimum without actually spending the money. So you do have to take it out, but that doesn't mean you have to spend it.
Yeah, yeah, and I really like doing that as well. It's just a way to move it into a non-registered account, and then now it's a lot more flexible. You don't have to do
Exactly.
anything with it. You can if you want to. So I do kind of like using that as a buffer there as well. And then basically in terms of what you have to pull out, that's just a set formula by the government. And basically it's a percentage that goes up with age. So basically it starts pretty small. Like if you were to turn your RSP to a RIF at age 65, it's only 4%. So if you have 100 grand in your RSP, you turn it to a RIF, you only have to pull out 4,000 throughout that next year. And then it goes up. I think by 71, it's like 5.28 or something around there. In the later years, that gets really high, right? If you're, I think 90 or 95, like all of a sudden you're getting into the 20% you have to pull out
20%,
each
yeah.
year. And so they are basically designed to slowly diminish the amount of money in the account because the government wants to get their tax money at some point. They want to tax you as you withdraw it.
Right, because at that point, there's no way you're earning 20%. So you're taking out all of your earnings, plus you're taking out a lot of principal. And yeah, so you're winding it down fairly quickly. The other thing I think to point out is that the percentage that you take out is based on your age or your spouse's age. And for me, one of the favorite things I like to do is I actually like to base it on whoever is youngest. So the youngest spouse's age. The reason is the younger you are, the less you have to take out. So remember, you can take out as much as you want. You can cash out the whole thing if you want. You're just going to get taxed on it that year. But to build in the maximum amount of flexibility, if we based it on the younger person's age, that's even less that you are required to take out. It does impact the withholding tax that Ben was talking about earlier. Um, uh, if you take out more than the minimum, because now your minimum is lower, but again, that's a temporary thing. Ultimately, the tax is the same. It's just based on how much you take out.
Yeah, well, and so two things really quick there. One, as you've pointed out, basing it off the spouse's age or the younger spouse's age, I think that's a great idea to do as well. Really, just to raise the flexibility. In a lot of cases, we're going to be withdrawing from that RSP a little bit faster than the lowest schedule
Yeah,
anyway, just for estate planning and tax planning purposes. But it does, yeah, if you have a lower minimum, you have more flexibility to work with and do what you want down the road. I just wanted to point out that that needs to be done when you set the RIF up.
right.
So it can't be changed later if you want to basically change the rules on that. It's just got to be done when it's set up. And then number two, I just thought it might be worthwhile talking now a little bit more about that withholding tax because I don't think we have it in the agenda further down. So just to describe that a tiny bit more, we already described it for the RSP, that basically whatever you withdraw, a certain amount gets withheld and remitted to the government. I say a certain amount because it's actually different depending on how much you withdraw at a given time. So if you withdraw less than 5,000, it's only a 10% withholding tax up front. Whereas if you withdraw, I think it's more than 15,000, it's 30%, right? And then 20% in the middle. So really just one thing you can do there is sometimes you can break up a withdrawal into multiple pieces. It's not always advisable to do because if you're going to be paying 25% tax later, to break it up into small chunks so you're only paying 10% withholding, it's just setting yourself up for a big tax bill. But it's something you can talk about and strategize with a little bit if you know you're going to be in a lower tax bracket to break those chunks up a little bit and minimize it.
Well, in some institutes, if they catch you doing that, they will actually bump it up to the higher amount
Right,
anyhow.
right. So it's
Yeah,
it's not
see,
always
yeah.
doable, not always advisable, but just thought I'd mention it.
No,
Uh,
decades ago, just quick story there, decades ago, we used to be able to do that we could do a withdrawal every day and it wouldn't trigger anything. And then, oh, I don't know, quite some time ago, we realized, well, some companies started implementing this rule. And so now we found if we wait a week, that tends to be okay. But there's no guarantee on that either. It's that bit is the institute doesn't have the discretion to not charge the withholding tax, but they do have the discretion to increase the withholding tax to the number that they believe it should be. So yeah, you do need to be a little bit careful about that.
yeah, well, and at the end of the day, it all gets
Yeah,
shaken out. The
exactly.
CRA
That's
knows
right.
what you've withdrawn. You're going to pay the
That's right.
same tax rate either way. Um, that is a good point too, in terms of requesting a higher withholding tax, because that's another thing that we often do. Um, so now, as it relates to the RIF, if you're only pulling out the minimum amount that the government makes you pull out, there is no withholding tax. So you don't have to remit any tax to the government up front. Obviously, when you do your taxes at the end of the year, you do have to pay those taxes. So oftentimes what we're finding is retirees do their taxes at the end of the year. They have let's say, an average tax rate of 15% or 25% or whatever it is. And they say, it might have been nice to have that 15% pulled out all the way throughout the year, or that 25% pulled out all the way throughout the year. So that's something we can facilitate as well, just to set that up front. You know what, let's just do the RIF minimums, but set a 20% withholding.
Right. Right.
If you're pulling anything out above the minimum, now those withholding taxes do have to apply. So that's just kind of the difference between an RSP and the RIF in terms of withholding taxes.
Yeah, and it does make those formulas a little bit confusing and complicated. But most of the time, you, the listener, don't need to worry about that at all. You just tell us, I want 1,000 a month, 2,000 a month. We'll figure it out, or we'll get the institute to figure it out. That's usually what we do.
Yeah, yeah. Well, and I think it's worth saying too, just quickly, when it comes to RSPs and RIFs, a client says, I want $5,000, and we say, great, but also follow-up question, do you want 5 grand net to end up in your bank account, or do you want to pull out 5 grand and remit some to the government and then you get less?
Exactly. Yeah.
Right. So
Yeah.
that
That's
just
right.
is always
That's right.
something that we got to bring up. I
You,
think it might be worthwhile. I'll let you go in a second, but where I was going to go is I think let's maybe just run through a timeline of like different ages. What do I have to do? What can I do with my RSP? I cut you off though. What were you going to say, Arnold?
well, it occurred to me, talking about things that we did not throw on the agenda, there is one other thing that I don't think we put on there. You should, our listeners should know that it's actually, some people think it's an irrevocable decision to convert your RSP to a REF. And after 71, it is, but you can actually convert a REF back to an RRSP. You still have to make the required withdrawal for that current year, but you can actually convert it back. So I think in my career, I've only had once or twice that we've ever actually done that, because usually once people are at that point where they want to take the income, they want to take the income. But you should know, if something happens and you really don't want it for a while, you can do that. You can convert it back to um, an RSP. So yeah, back to Ben's point, age-based milestones. I mean, really good point. When you're 40, can you turn your RSP into a RIF? Yes, you can. You probably don't want to, and it would be rare that that would be advisable. The government doesn't prevent you from doing it at all. The thing is, if it's an ad hoc need, you can take it out of the RSP just as easily out of the RIF. If it's an ad hoc need, not just like if you don't need it on a monthly basis, the only difference is that withholding tax that we were just talking about. And like I said, once you convert it to a RIF, now all of a sudden you have to take that money out. Unless again you switch it, but then you still have to take it out for that year unless you switch it back to the RSP. So there's some temporary um, tax implications, RSP versus RIF. But really, at the end of the day, it works out to the same when you do your taxes.
Yeah, and I think what I'd say there too is that by moving your RSP to a RIF, you're now signing on for taxable income for life from your RIF or until you've withdrawn it all. Right. And so in this case, we're assuming that the 40-year-old is still working. If you're one of those people who's retiring super early and you've got tons of money in the RSP and you don't think you're ever going to go back to work and you want to just get income, maybe that does make sense. But for the rest of us who are still probably going to be working at that time, it wouldn't make sense for me to trigger the taxable income each and every year going forward when I'm also earning a salary and it's bumping me up into a higher tax bracket.
Yeah, better off to
Um,
take out the lump that you need, throw in a bank account, and withdraw 500 a month out of there, instead of creating the income stream. I agree 110%.
yeah, and I think the thinking that backs all of this is just that what we're trying to do is we're trying to spread out. I think of RSP and RIF withdrawals as one big tax liability, one big tax event. And I'm trying to spread that tax event over as many years as humanly possible. And that's a little bit tricky because we don't know when the client is going to pass away or when this or that. We don't know what the market returns are going to be. There are a number of factors that go into it, but that's sort of the thinking that goes into it and why we're saying it probably doesn't make sense to be withdrawing a lot from your RSP or your RIF while you're also still earning a high income, of
Well, I
course.
think it's worthwhile pointing out that the reason for that is what we're trying to achieve is a lower tax liability over life, or I guess an ultimate lowest tax liability, and that's best achieved by keeping people in a lower tax bracket for a long period of time, rather than either, a whole bunch of withdrawals causing higher tax brackets. Remember, because every time you take that money out, it's adding on to your income, or taking nothing out and dying with $1 million in an RSP or a RIF. Well, that also is going to subject, at least you got lots of years of tax-free growth, but now all of a sudden you've got a tax liability in the plus 50% on that, right? So that smoothing out that Ben was talking about, that helps reduce your taxes overall.
Yeah, yeah. So I think that's sort of the case for early on, what we talked about. I think now let's fast forward a bit. I've written down 65 here, but really let's just call it retirement age. So that might be 60, 62, 65, 68, whatever you want to call it. Now what? Can I move my RSP to the RRIF? As we've talked about, you still don't have to yet. We talked about the age 71 requirement. But now it's becoming a much more feasible thing to do. You can now convert your RSP to a RRIF if you're at the stage where you're going to start to want to get income from that for life. That can be a very good thing to do. One reason that we do like to do that is for some amount of income splitting with your spouse. That's less of a factor than it used to be, but can be important to do when you've got some basically pension income. And with the RRIF, that counts towards the pension tax credit. So basically up to $2,000, it's not a huge limit. If you're 65 or older, you can collect a pension tax credit for any pension income. So especially for people who don't otherwise have a pension,
Yeah.
or who aren't yet collecting CPP or OAS, that can be a good thing to do.
Yeah, no, I absolutely agree. It's just a tiny little trick to get a little bit of tax-free or lower tax money out of the REF, because you do get that pension tax credit. After you're 65, it's worthwhile considering that. Yeah, and I guess the other thing that I had been thinking about was so you make the decision to convert the RSP to a RIF at again, let's just say 65. Usually for most people, that's because they want a regular ongoing income stream, like a monthly amount. I think, if I had to look at my practice, probably 3/4 of the people that have RIFs are getting, or maybe 60% or more, are getting a regular monthly payment because they want that regular monthly income stream. And you can't do that with the RSP. So then you need to convert it to the RIF in order to do that. So at retirement, it's a tax consideration. There may be other ways to do things, but most people are going to want to do that. One thing that sometimes people don't think about is it doesn't have to be an all or none proposition. If you want to get that, let's say $2,000 because of the pension credit, you can just convert 20 grand. It doesn't have to be the whole amount. So you can have an RSP and a RIF. It's not an either or. You could have both. So lots of flexibility there, but those are the kinds of things that we look at.
Yeah, well, and we've talked about, there's a minimum amount you have to pull out. We haven't talked about, but there isn't a maximum that you have to pull out
Good point.
in a regular RIF. And so if you want exactly $2,000 per year from the RIF, as long as that's over your minimum, we can facilitate that.
That's right.
If you want exactly 500 a month, whatever it is, basically you can do that however you want. You can set a dollar amount. You could take it monthly or bi-weekly or annually, or whatever you want to do. But now let's maybe fast forward again. We've already highlighted this, so maybe we'll go over it quickly. But now you're 71. Now what? Okay, well, if you still have an RSP, by the end of that year, you have to turn it to a RIF. and you can't contribute to an RSP anymore unless you have a younger spouse, right? And if they have a spousal RSP, then you can still use up some of your remaining RSP room. But other than that, basically now it's in a RRIF, now it's being withdrawn.
So actually good time here for me to point out a little trick that is seldom used, frankly, actually seldom available, but I have used it a couple of times in my career and it's saved people thousands of dollars. If you're turning 71 and you're still working and making an income, you're going to generate RRSP room that year, but next year you don't have, or actually, I guess should clarify here. Your spouse also has to be, if your spouse is less than 71, you could still contribute to your spouse's RSP, but you couldn't contribute to your own. So when the youngest of you is turning 71, you could, if you wanted to, in December, make an RSP contribution for RSP room that you don't even technically have right now because you don't get it until January 1. So if you know, if you can figure out what your income is, 18% of that income up to a maximum is how much your contribution room could be, you can contribute that in December. You will pay a penalty tax of 1% because you didn't have the room in December, but on January 1, you do. And now, if you have this younger spouse, you can contribute into their spousal RRSP and end up getting more in your RSP and saving more in taxes. It's a very niche, rare opportunity. But if you've got a younger spouse and if you sorry, no, that even applies even without the younger spouse. If you're turning 71 and you have employment income and an RSP makes sense for you, then that can make sense to do. But don't try this at home, kids. Get professional advice.
Yeah. No, I was referring more to just if you have the younger spouse. So yeah, it is two separate things. But basically, if you have a younger spouse who's still basically under 71, you can deposit even after age 71 yourself to their spousal RSP.
Yeah, so my trick works more when the both spouses are no longer able to have RSP room. Yeah.
Well, and that's going to make a lot more sense too for higher earners.
Yes,
who are
exactly.
Still working at that point. So
yeah.
Other than that, wanted to chat a bit about our RRIF spin-offs, I guess you'd call them. So similar to how we had talked last time a bit about, an RSP has similar different other accounts like locked-in plans. So a locked-in RSP would be something that's come from an employer. But basically, those follow the same general formula as the RRIF does, in that if an RSP goes to a RRIF, well, a locked-in RSP goes to a locked-in RRIF. What else have we got? A locked-in retirement account goes to a life income fund.
Or a spousal RSP goes to a spousal RRIF. And actually, there's another trick there. Normally, when you pull money out of a spousal RSP, if you've contributed to another spousal RSP any time in that year or the previous 2 years, that withdrawal is going to get attributed back to you. It's not going to go on your spouse. If you want it going on to your spouse, there is a bit of a trick. You can convert it to a RRIF, and then that minimum withdrawal doesn't get attributed back to you. It actually goes to that spouse. So another little trick for spousal RSP/RRIF holders. Sorry, I cut you off there, Ben, but it just occurred to me. Again, another thing not on our agenda, but a weird little niche trick for our listeners.
Yeah, well, and a lot of these things come up, like, they're not really on our agenda, but you see it and you think, oh, that could be a neat way to handle this problem. So yeah, no, that's a good point as well. I was going to start chatting about the locked-in plans a little, just to highlight too that basically if the money's come from an employer, from a pension plan, basically then it's what it sounds like. It is locked in. So that's where there would be some additional restrictions. Um, that's where you wouldn't be able to withdraw it if you're under the age of 50 or 55, depending on the province. And well, another thing that matters is even if you live in BC, is your pension federally regulated or provincially regulated? So that's something you want to keep an eye out for. Generally speaking, if you have a locked-in retirement account, a LIRA, that's probably provincial, and if you have a locked-in RSP, that's probably federal.
But being provincial doesn't necessarily mean BC. We have lots and lots of provincially legislated locked-in accounts that the head office of the company was in another province. And actually, that's a good thing because there's a weird unlocking provision that a lot of other provinces have that BC does not.
Yeah. Well, and this topic too. I mean, we highlighted when we started the podcast that we'd kind of highlight when things are very BC specific. This is one of them. Just depending on how your pension is regulated, that is going to change the rules that we talk about here a little bit. But the pension unlocking that, or one of the rules that Arnold was talking about is the pension unlocking. So in other provinces, if you have a plan, when you move it to an income fund, you can unlock 50% of it to a regular income fund that is no longer locked in, right? In terms of the locked-in function, because we haven't really talked about that yet, but it's basically, let's say you have a locked-in RRIF. Basically, it still has the minimum withdrawals that the RRIF has, and they're the same. There's also now a maximum that you're allowed to withdraw from the plan. And the idea there is just, again, because it came from a pension or because it came from a work employer, an employer, it's intended to replace a pension, and the government doesn't want you withdrawing all of it right up front and blowing it and then being destitute, all throughout your retirement. So they do put on a limit to how much you're allowed to withdraw in a given year.
And that can actually give rise sometimes to some problems. I know actually I was talking to a client earlier today, and planning to burn through her RIFs as quickly as possible, or quite quickly. For I won't get into why, but when we looked at her accounts, a large portion's in a RIF, and another large portion is in large portion's in a LIF, and another large portion is in a RRIF. So the LIF is the locked in one. And so there is a hard cap on how much she can take out of the one. So we have to take more out of the other. And so it's going to diminish even faster. So that can pose some challenges sometimes for some people. So it just needs to be planned for and reviewed and tried to work around if you can.
Yeah. And so those maximum withdrawals that are coming from the locked-in plans, those are generally speaking, it's close to double what the minimum is. It's not quite, but it's sort of in that range. So if you have to pull out, 4% from something, you're allowed to pull out 7.4% or something around there on the maximum side, generally speaking. So that's based on the formula. There is also a separate rule that basically you're allowed to withdraw any investment income from the prior year. And so that can lead to some funny instances as well, where if you set up, just pull out the maximum each and every year, if we have a year where investment returns are massive, then you can pull out quite a bit the following year. And then the year after, if returns haven't been quite so phenomenal, now all of a sudden the amount you can pull out shrinks dramatically. So it can be quite choppy if you're following that strategy.
Well,
we get some lumpy.
We had some clients a few years back. We had an outstanding year, and all of a sudden they're used to this 2,000 a month coming out of their LIF, and because we've got it set at the maximum, and the next year in January it drops down to 1,000, and they're calling us up saying, "What happened? How come I'm getting so much less?" And yeah, if you're getting used to it, that can be problematic. So yeah, it's just something to be aware of.
Yeah, yeah, for sure.
I mean, in a way,
Um,
you do want to get as much out of there as you possibly can, because that, as long as it's not putting you into a higher tax bracket, because that is the restricted part, right? We like to see less restricted rather than more. So it's nice to get as much as you can out of there. You just need to be aware of that, sometimes it's going to back down because, well, last year we had a very good year. This year, people are being able to take out a little bit extra. This is, we're probably going to run into this again next year.
yeah, yeah. The other thing, basically, before we move on with the locked-in plans, just wanted to highlight too that, I mean, we've talked about a maximum that you're allowed to withdraw, so on and so forth. Just that there are some provisions for if you're going through a
Yeah,
financial
good point.
hardship, if you've got a shortened life expectancy, what have you. Again, those are going to vary province by province. So there's a completely different set of rules, whether it's a BC pension or an Alberta pension or an Ontario pension or a federal one. But basically, if if there are some extreme situations, you might be able to get around those rules a bit and unlock some of that money.
Well, and they are quite reasonable about it. We've run into a number of situations where people have been diagnosed with cancer and don't have long to live, and they've been able to pull out significant sums because they needed it, or low income as well. So yeah, they're quite reasonable in terms of those exceptions.
Yeah, yeah. So I think those are most of the things we wanted to go to. I did want to circle back just to one other thing, talk a little bit more about withdrawing from a RIF. Like, let's say we're moving back to the regular RIF, no restrictions on how much you can pull out. How would you suggest you structure the lifetime withdrawals of that? Should you follow the minimum? Should you try to accelerate it a little bit based on life expectancy? I know my answer because I'm trying to, like we talked about already, try to spread that tax event out as much as possible. Arnold, what are your thoughts?
Oh, there you go. He's throwing a trick question at me. He didn't warn me about this one. So, in a perfect world, uh, I want to bring people up to a certain tax bracket. So, a really good example actually was the other day I was talking with a client who um, wanted a higher income than what they were getting, and so we took a look at um, the um, level at which the old age security clawback kicks in. And I said to them, look, hard line, I really don't want your taxable income to go above, I think it's 95,000, 94,000 and change. It was around $95,000. Because once we cross that level, it's not an extra tax, but it's pretty much an extra tax. You've got a 15, your old age security gets clawed back by 15%. So it's as though your tax bracket is just increased by 15%, 15 more percent on top of where you're already at. So so the strategy became to keep their taxable income within a band of that 95,000. And yes, since Ben just sprung the question on me, I don't have the exact number here, but around 95,000 below that. Um, but with a fairly wide um, range, because having a whole bunch of other non-registered money where we don't always know how much their dividends or capital gains are going to be, we need to leave a bit of flex room in there. I wanted basically just get them in an ideal world, we would know exactly that number and we would get them to exactly that dollar amount. But in reality, we have to leave a little bit of flex room, and so we target that taxable bracket. So that's my answer. Targeting a specific tax bracket is the ideal.
Yeah, yeah, no, good. And then the other thing I wanted to just touch on as well was basically, I think you touched on it earlier, but I don't know if we quite made the point, is just that um, on death, if someone has a lot of money in the RSP or in the
Good
RIF,
point. Yeah.
again, let's say there's 400 grand in the RIF, that is a taxable $400,000 to the estate. And so oftentimes we're trying to withdraw the RRIF a little bit sooner to try to spread that out over more years, or if there's a spouse involved. So basically, if there's a spouse, you can do a spousal rollover on death, and the RRIF can go to the surviving spouse's hands, and you don't have that $400,000 of income tax all at once.
Yeah.
I mean, at some point, the spouse now has to continue withdrawing it, and if that's taxable to them now, and if they pass away, then again, it's a taxable event.
So
But,
just a quick clarification on that, that 400,000, it's not just taxable, it's taxable on top of your other income. So if you've already earned 50 grand, it's now 450 that your tax is going to be based on. Or if you've earned 100, it's now 500. So, you want to die in January 1, right? So you don't have a lot of other income, but most people can't orchestrate that real well. So yeah, so that RRIF or RSP, whatever it is, that full amount becomes taxable unless you have a spouse, then it can transfer to them tax-free. I think it's also worthwhile noting, when one spouse passes away, now you've only got one spouse's income. And if their income is higher because the two of you were used to living on a certain amount, well, they're in a higher tax bracket. So it is better to do this while both spouses are living, to try to orchestrate. I mean, sometimes sometimes people are so anxious to get that money out of the RRIF that they're taking too much out and putting themselves in too high a tax bracket. So, it's not that they're evil. It's just knowing that, knowing how they work, trying to orchestrate a metered out plan that takes advantage as much as possible is the best way to do it.
Yeah. Well, and so like you said, it's a balancing act between the two. But that's really more where I was going with the question, was just that sometimes it's beneficial to accelerate those RRIF withdrawals a little bit, even more than what the minimum amount is that you're forced to. That can depend. Again, you're trying not to always go into an upper tax bracket. But again, there too, I mean, you don't always have to spend that immediately. If we've got someone who's got quite a bit in their RRIF and they're a little bit older, you can start shuffling money over to the non-registered plan or to the TFSA a little bit sooner. And so it's still there, still invested, still able to be used for income later. It's just you've triggered the tax a little bit year over year over year, so that it's not all done at once to the estate. Yeah.
Best to just try to think about the lifetime tax liability and reducing that.
So that wraps up today's tour through the retirement income phase of your RSP. So if you're wondering what this means for your personal retirement plan, visit visionvest.ca to book a free financial health consultation. And please remember to like the podcast, and thanks for listening. We'll catch you next time.
Thank you.
The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.